Imagine waking up to this headline. US and China slash tariffs, markets erupt higher. That's exactly what just happened, and it's sending shockwaves through global markets. The US agreed to cut tariffs on Chinese goods from a staggering 145% to 30%, while China reciprocated by reducing its tariffs from 125% to 10%, at least for the next 90 days. It's a truce, and for now it has injected massive optimism into risk assets. Markets reacted instantly. S&P futures surged 3%, Nasdaq futures shot up nearly 4%, and even the Russell 2000 popped 4%. Semiconductors, cyclicals, and mega-cap tech names, especially the so-called Magnificent Seven, rallied hard. Apple jumped over 6%, Amazon and Tesla both surged around 7%, and even Shopify soared after it was announced it would be added to the Nasdaq 100. Markets just witnessed one of the biggest short-covering panics in years. Hedge funds scrambled to unwind their bearish bets following the sudden melt-up in stocks, triggered by a surprise US-China tariff truce reached over the weekend. That deal, born from a secret meeting between top officials in late April, sent shockwaves through equities. And on Monday, the fallout was clear. Hedge funds rushed in, covering short positions at one of the fastest paces seen in half a decade. Hedge funds jumped into the market in a big way, kicking off one of the strongest waves of stock buying in recent years. The size of the move was highly unusual, the kind of surge that only happens on rare occasions, when traders rush to change their positions all at once. But it wasn't just regular buying. Most of it came from hedge funds closing out their bets that stocks would fall. This is called short covering. When you short a stock, you're betting it will go down. But when the price goes up instead, you start losing money fast, so you're forced to buy back the stock to stop the bleeding. That's what happened here. A lot of investors were caught off guard and rushed to buy back stocks, which pushed prices even higher. But it wasn't just stocks. Commodities like oil and copper spiked, with Brent crude rising more than 3%. At the same time, bond yields jumped as investors rotated out of safe havens. The 10-year Treasury yield climbed to 4.45%, and gold took a sharp hit, dropping over $100 an ounce as demand for safety evaporated. The dollar, on the other hand, ripped higher to a one-month peak. So what does this all mean? For starters, the risk of a deep U.S. recession just took a major step back. According to market strategists, this kind of tariff de-escalation clears the fog around corporate earnings and allows investors to recalibrate growth expectations higher. If inflation numbers like CPI and PPI later this week surprise to the upside, it could further fuel the rally. Normally, hot inflation means trouble. Higher CPI or PPI usually leads the Fed to keep rates high, which can weigh on markets. But this time, the market might rally instead. Why? Because the US-China tariff truce has changed the outlook. With trade tensions easing, investors may now interpret strong inflation as a sign of resilient demand, not a policy risk. So rather than fearing rate hikes, the market might be positioning for growth. Earnings expectations could improve, recession concerns may ease, and the Fed isn't signaling panic. It's not just the data, it's the context that might drive this rally. Still, not everyone is celebrating. Drug makers tanked after President Trump announced a sweeping executive order to cut U.S. prescription prices by as much as 80%. Pharma stocks in the U.S., Europe, and Asia all slid, wiping billions off their market caps. Meanwhile, defense stocks lagged as geopolitical tensions cooled on multiple fronts. Around the globe, optimism spread quickly. Asian equities closed higher across the board. In Europe, markets jumped, led by mining and consumer sectors. Even emerging markets rallied, with India's Nifty 50 up nearly 3% and Pakistan's benchmark surging 9% after the two nuclear-armed nations agreed to a sudden ceasefire. This isn't just about tariffs. It's about the tone of diplomacy. U.S. officials described the talks as very robust and productive. China echoed the sentiment, calling the dialogue candid and constructive. Both sides agreed to establish a permanent consultation mechanism and pledged to avoid decoupling. That's a strong signal to markets that we may be witnessing not just a pause, but the beginning of a broader thaw in U.S.-China economic relations. Now, as we head into a critical week of U.S. economic data, CPI, PPI, retail sales, consumer sentiment, all eyes will be on whether this trade optimism can be sustained. Fed Chair Jerome Powell is also set to speak Thursday, May 15, 2025, and any comments on inflation or rate policy could add fuel to this risk on fire, or douse it. So here's the big picture. A tariff truce, a global equity rally, a dollar surge, and a sudden drop in safe havens. It's a massive pivot, and while it's only for 90 days, markets are betting this could be the start of a longer-term resolution. Stay tuned, because the next few days will tell us whether this is just a sugar high or the real turning point the market's been waiting for.